Hello and welcome to the Providence Investment Webinar. My name is Michael Ogg. I'm a Director and Senior Advisor at Providence. With me today we have Grant Patterson, Founder and CIO of Providence.
Thanks, Mike.
Welcome, Grant.
Thanks, Mike. Thanks, everyone, for joining us.
We're also delighted to have Jonathan Shapiro as our special guest. Jonathan is a Senior Reporter at the Australian Financial Review. Jonathan has covered financial markets for the Fin Review for the last 12 years. Jonathan has been involved in several investigative reports involving the likes of Slater Gordon, Biggin, Dixon Advisory, Mayfair Platinum, and so there should be plenty of stuff to talk about.
Yep.
Jonathan has also recently published a book, Buy Now, Pay Later, The Extraordinary Tale of Afterpay. I've read the book and I can say it's a very good read. So welcome, Jonathan.
Thank you. Thanks very much for having me. It really is a privilege and honor to be here, and I'm looking forward to the discussion.
Yeah, me too. So just a bit of housekeeping. Today's webinar should be around about 35 minutes. If you do have any questions, please feel free to put them in the tab below. We can see the questions coming through, and we'll try and answer them as we see them. We will also be leaving some time at the end for questions if it's needed. So, Jonathan, let's start with you. Buy Now, Pay Later, The Extraordinary Story of Afterpay.
Yes.
Can you please tell us why you wrote the book and a bit of background?
Yes, sure. Well, Michael, I was here something I prepared earlier. I've got some slides just to talk us through the story, but the first slide was actually, I'll go back to the first slide is actually, the extraordinary story of Afterpay. And as you've just asked why I wrote the book with my colleague James Ayres, and there's two reasons. I mean, one is Afterpay as a narrative. It was just an extraordinary. I'm repeating the title of the book, but it was an extraordinary story, an extraordinary narrative of twists and turns and near-death experiences and plot twists. So the company's it was only created 2015, but it's just gone through it's gone through a white knuckle ride. And myself and James were talking around June, July last year, just after COVID had smashed the share price down to $8, but it turned around and went up back to $60, $70. The event that was supposed to kill them made them stronger, and that was the moment we realised that this company wasn't going anywhere. It was here to stay. It was a force to be reckoned with, and it was just an incredible corporate story, probably one of the most interesting that has ever occurred in Australia, certainly up there. The other reason we wrote the book is Afterpay is just so divisive. You know, there's never been not only the company's divisive, so not only have share market investors throughout its full journey from micro cap to small cap to mid cap to large cap, not only have investors kind of debated whether it's how to value it. Do you value it like a bank, like a lender that makes a margin and needs that capital to grow and probably not so profitable? Banks aren't at their core very profitable, or is it like a tech or a platform company? You know that as it gets bigger, it scales and it becomes enormous. And these are so. Is it a tech or lending company? That was one divisive issue. The other one was the actual product or the offering itself. Are you lending people money, or are you helping them make payments? Is it good or bad? Is it getting young people into debt, or is it helping them budget? These are all. And you had people with totally opposite views, how it should be regulated. ASIC, the RBA, and the RBA, and others have looked at it and, from a different lens and can't decide how to, do they regulate it like a lending product or do they give it some leeway? So just throughout its story, it was so divisive, and there's so many extreme lovers and haters of the story. So. And look, if I'm fair, I was one of those people that had used to just kind of really, confuse me. Yeah.
Well, I think that's one of the reasons why we love sharing this story with our clients is that we want to learn ourselves about how do you value a company like this? Where does it fit in your portfolios?
Totally, yeah.
How do you what's the valuation? Can you ride the volatility? So after reading the book, I can see it's sort of not an overnight success when you look at the people behind it over a long period of time, and I'm looking forward to hearing that journey as we go through.
And that was an epiphany for more myself than James, my co-author. But sometime June, July, August last year, I said, I don't have to decide. I'm a journalist. I just need to tell the story. I don't have to. I'm not investing in this company. I just need to kind of. I objectively sat back and went, this is really fascinating. It's divisive, but that's the good thing about it from a journalistic point of view. So I'll go through some of the story. I mean, this slide is kind of the beginning of Afterpay, and to be fair, in our book, and as we the beginning of Afterpay probably goes back 100 years before today, or maybe even longer, when Singer sewing machines realised, that if they offered instalment payments, it would help drive the sales of their sewing machines. And the people that bought the sewing machines would either be able to afford future payments through through making clothes, or either through savings or through running a business. So that was kind of one of the first kind of buy now, pay later products. And there's a whole journey of credit that took place to the moment where on that slide you can see a little red dot that's actually moved a little bit further to the right than it should be, but where two people in the eastern suburbs, Nick Molnar, a relatively young kid, met his neighbour who's 20 years older than him, Anthony Eisen, and kind of pitched him this idea of point of sales credit. So Nick was an entrepreneur himself. He was selling jewellery out of his bedroom for quite a large US online retailer, and he was very good at it. He was a real digital native, and he'd mastered the art of online sales. And his neighbour, Anthony Eisen, was a seasoned banker / investment professional who had gone through an interesting time at Guinness Peat Group, which is a very well-known Australian investment firm known as corporate raiders. But the irony about Guinness Peat is they were corporate raiders, but they had effectively been raided themselves. And poor Anthony's role is he kind of had a path to the top to possibly run Guinness Peat, but his job when he met Nick was to dismantle it and sell all the assets. So he was in this wind-down mode and kind of putting himself out of a job, and that was good timing for Nick, because he had a smart youngish banker willing to help him out, and they created this thing called Afterpay, and it was a bit of trial and error. But I guess before I go on, I should probably explain to everyone how Afterpay works very simply. So it's a very elegantly simple idea. Is what you do is it allows you to break payments up into 4 equal payments over 6 weeks. So if you walk into a store and you want to buy a pair of jeans, rather than pay $100, you can pay $25 in equal instalments over 6 weeks, and you don't have to pay for that cash advance. It's paid for by the merchant. So Levi Jeans will pay 4% to Afterpay on the premise that it had helped them generate a sale. That customer wouldn't have bought the jeans, or maybe wouldn't have bought 2 pairs of jeans were it not for Afterpay. So they're quite happy to hand over that 4% fee. They had this idea. It was very trial and error. It didn't seem like it was going to work when they first floated the idea. They tried it with a florist, and it totally bombed. But then they had a bit of luck with a young woman's online fashion retailer called Princess Polly that just found their website, Afterpay's website, and put it on, and their sales exploded through having this Afterpay option. So they felt like they had actually had a product. Then they had to raise money. So fortunately for Anthony, through his connections at Guinness Peat, he knew the CEO of a company called Touch Corp. He'd actually sold Touch Corp as part of his unwinding of Guinness Peat, and he went to the CEO, Adrian Cleave, and Adrian agreed to build the technology of Afterpay for 1/3 of the company. So but then they still needed capital. So their very first fundraising was Touch Corp owned 1/3 of the company for building the technology. Anthony and Nick roughly retained about 1/3, and the other 1/3 was high net worth investors that were sourced through the Guinness Peat network and through some stockbrokers in Melbourne that built the built the book, and then they were ready to go. And
Jonathan,
yes.
can I ask a question on the network? Because it seems that the network they had was so important
Yes.
to the success. I mean, it's all the right people together at the right time, doing the right thing. Is that a fair comment?
Yes, absolutely. I mean, one of the very senior Afterpay people that we spoke to as part of the book said it was the ultimate network company. Like the product was a network, and the people were networks. They just knew all the right people. Although there was an element of serendipity, so they had the network, but they still had to, the network still had to be navigated and explored. And I guess having a network increases the probability of that serendipity working out, and I think that's probably fair. So they ultimately found the right investors and the right kind of. There was a guy called, I think, Paul Greenberg that that Nick had actually known. Most of the network came from Anthony, but Nick had met this Paul Greenberg guy who knew the retailers and set up all the meetings with retailers. That was so important. But the other interesting thing is, so they had to win over the merchants to get them to use their product, and that Princess Polly experience showed them that it was powerful. But then they had to kind of really hustle to get other merchants to at least try Afterpay. And one of the big breakthroughs was a company called Q Group, which a lot of people would know. It's a very quintessentially Australian fashion brand. They're very committed to Australian-made products. And the interesting thing is Anthony Eisen's cousin is Justin, who's the son of the founder Rod, who was running the business. And they went to see him. And while Princess Polly put Afterpay onto their platform and found it was incredibly successful, they thought that it would help young people that didn't have that $100 or $200 to buy the dress or the shoes or the sunglasses that they were selling. But the Justin at Q had a very different idea. Because Q had been so established, they had they had a big lay-by problem. Going back, lay-by had been around for decades, and lay-by is a real pain in the neck for retailers because they have to store the stock and collect the payments. They run at tight margins anyway, but to have this hassle of lay-by really was a problem that he needed to solve. And Afterpay's
the digitalised version.
Yeah, so he felt that he could do away with lay-by without discriminating against the customer because, if payment is an issue, don't worry, you can take the goods home and we can sort out the payment through Afterpay. So he loved the idea, and what they found is it just really took off. So women would come in and instead of they would buy the whole outfit rather than just pieces. So Afterpay really unleashed it. And I guess the interesting thing about Afterpay is there's two, like the Q and Princess Polly demonstrate, there's two reasons to it. One is it giving credit or capital to somebody that doesn't have the money, or is it a behavioural hack that helps people overcome that large sticker shock of the price? It's probably both. So, it's practical sense, is it giving you money, or is it a clever kind of psychological trick to induce you to spend more? And that's kind of an issue that we kind of get to right here on the next slide, which is as Afterpay became more successful, it became more divisive as a product. Like guys like Scott Pape, who's hugely influential, he saw this new product and this new thing, and he was obviously getting asked a lot about it a lot by his readers. And he settled on the notion that it was a financial equivalent of marijuana, which was that in itself it's probably not dangerous, but it's a gateway to young people taking on more credit. And just to the left of Scott, there's a marketing poster that became very controversial. Broke AF, but strongly support treating yourself. I'll leave you to work out what AF stands for. It's a millennial term, but basically encouraging you to spend money even if you don't have it. That poster. And Afterpay was distanced themselves from it, but it got the consumer groups really worked up, and it was just kind of the early battleground from consumer groups about the vices and virtues of Afterpay. And as Afterpay listed, that kind of debate around Afterpay migrated to the stock market. So a lot of it is overlap with the consumer issue. So on this slide, you can see ownership matters. The governance analysts found that back in 2018 that there was a loophole where you could be under 18 and buy stuff on Afterpay by just putting in a birth date that was that. And that created a huge problem for a huge potential controversy for Afterpay. Then we also had, as the stock was going up, you had a lot of interest from investors wondering, is this all going to come unstuck? Are they going to be regulated away? I mean, one of Afterpay's edges was that they structured themselves as not a provider of credit. They were saying the loan was just of a short enough date that it's almost like an unpaid invoice.
So they're a platform provider, right?
Yeah. So and they kind of lobbied and suggested they weren't a lender; they were a way to pay. And that really, the ASIC got involved and thought they needed to have a look at it, and politicians got involved. There was a Senate committee set up to kind of just look at this buy now, pay later sector that was growing so quickly. Yeah, and it became a regulatory battle, a retail issue, and a very divisive stock market battle between bulls and bears. And throughout its time, it listed at $1, but there's an analyst we quoted, a fund manager we quoted at the end of 2016, which was very, very early on, lamenting that as great as Afterpay was, it was on 40 times sales, and that's just insane. And to the right, there's a comment from Kramer also kind of saying overpay. And without ruining the punchline, they got taken over by Square at 40 times sales. So throughout this whole journey, they've been at 40 times sales.
And that's a really tough issue for fundamental investors, is to get your head around how you value these sort of companies. This has been a great success story thus far.
Yes.
And but along the journey, it's been incredibly volatile. I mean, the emotional impact of investing in a stock, you would have had to withstand a 75% fall in the share price to still be a shareholder in it today. And I don't know how you feel when it's down 75%. I'm sure I would have sold well before then.
There were lots of white knuckle moments. One was when ASIC said they were going to regulate it. The stock dropped 20%. There was a lot of tension around. There were a lot of binary moments where regulators could have gone this way or that, and but it's an interesting one because Afterpay is like it's part of this new generation of stocks where like a startup obviously doesn't make profit, but like startups are now becoming bigger and bigger and older, and the startup way of valuing a business has now become bigger. Even in Amazon, this breaking even takes longer. So you almost have to extrapolate further into the future, and the investing debate becomes around terminal value and total addressable market, and it becomes a very different ball game, and one where you are playing with a lot of option probability and
you've got a lot of optionality, and it's like Canva. I see, the most valuable private software company in the globe. I mean, it's just recently raised capital to value the company at $54 billion, which was valued at $8 billion 12 months ago. So that's been a good leg.
Yeah, no, look, I've got plenty of sympathy for investors that didn't buy Afterpay, which I think is our next slide. Yes, exactly. Which is these are just investor performance notes from Australian funds that are pulled off of a part of researching in the book. And what they show is there's 5 of them, and they all show these funds are disclosing their biggest detractor for the quarter or the month. And these are, some of them are small caps and some of them are large cap stocks, and they're all telling their investors the fact that they didn't own Afterpay is the reason one of the 3 biggest contributors for them underperforming or detracting from their performance relative to the index. So, I mean, there's a lot of talk about that Afterpay. A lot of the retail investors that own Afterpay like to point fingers at short sellers, and that the short sellers are spreading rumours. But in my experience, I didn't really speak to that many short sellers throughout my time covering Afterpay. I know they were there, but there weren't that many that were vocal. It was often the long-only institutions that were getting hurt.
Pressure,
Very hurt quite badly from not owning Afterpay. And again, I've got every sympathy for them. Everyone has their own their processes, and a lot of these managers, I haven't named them, they've done fine without owning Afterpay. They've delivered returns to their investors in their own way. So
it's very difficult as a fund manager when you're seeing front page of the paper of a success of a stock, and your clients will say to you, well, why aren't you there? Look, and it's you sort of jump at shadows.
And that's probably why it's so divisive, because these fund managers are getting these questions, and they're probably tired of getting them. And but look, there were a lot of Australian fund managers that did own it and did very well. This is one that didn't own it, and their writing's a bit small, but hopefully you can see it. And these guys were just saying how it was the ultimate kind of concept stock of our time, and look, they might be proven correct. I know there's been a takeover of Afterpay, so the valuation, the Afterpay share price debate is over, but I wouldn't be dismissive of this line of thinking from this investor. So it's a very
Jonathan, I think just sorry to interrupt. This touches on that whole thing about growth versus value.
yes.
So you speak to a growth manager, and most growth managers or a lot of growth managers are in the stock. This is their perfect stock. It's growing to the moon. And the value managers like IML just couldn't, because of their process, they couldn't own it. They really couldn't.
Yeah, and I think that's totally fine. Yeah, I think that's totally fine. So I mean, to this day, I don't think I know it seems like there's a right and wrong in Afterpay, but there's an intellectual right and wrong, and I don't think that's been settled. But people that did get it right are these guys. Now, this is a story in itself, I think. So some people, some viewers that follow global capital markets would have heard of the Tiger Cubs, and the Tiger Cubs are like I said, they're a story in themselves. So the guy on the right-hand side in the suit and tie is Julian Robertson, one of the most famous hedge fund managers of all time. And what is fascinating about Julian Robertson is in talking about growth and value. Julian Robertson was a very hardcore value investor. And in 2000, he was owning airlines and cyclical stocks that were just getting pulverized as the NASDAQ boom took hold. And he was underperforming and getting redemptions and having to sell out of his cyclical stocks because the world had gone gaga, as he said in his investor letters, mousetraps and momentum. Eventually, he shut the fund down. He closed it down and gave back the investors their money because he just got squeezed out by the tech boom. But the irony is that's kind of made him immortal because the money that he didn't, the money that he had, he gave to his junior analysts, and his top PMs. And 21 years later, these Tiger Cubs, because his fund was Tiger Management, the Tiger Cubs and Cubs of Cubs are probably like one of the most powerful kind of coordinated group of hedge fund managers out there. I mean, just below Julian is a guy called Chase Coleman, who runs Tiger Global. Steve Mandel, who runs Lone Pine. The guy under the Cub is Philippe Lafont, who's like obsessive technology investor who worked very briefly for Tiger. And his famous stories in 2007 when the iPhone came out, his team dismantled it and bought all the kind of providers that were going to that's all the suppliers of Apple. They went long, and everyone that was on a list that didn't, they shorted them, and that became kind of his greatest trade. And there was a very young Tiger Cub called Jim Davis, and he stumbled on Afterpay, they were just seeing the data come up a lot, like in credit card transactions that they probably bought through doing their data analysis, and they kept seeing Afterpay coming up, and they did their research, and they found that amongst college females, there was an 86% recognition of who Afterpay was. So I probably skipped a step in that Afterpay went to the US and grew phenomenally. And I think they were almost dragged there by their merchants saying, they're global merchants who are operating in Australia, if you don't come to the US, we're going to find someone to offer this because it's so valuable to us. So they jumped over the pond and set up in the US. So these Tiger Cubs got the Afterpay growth story, and they all piled in very, very aggressively and made a ton of money and made a huge amount of money during COVID when Afterpay, post-COVID, when Afterpay really ripped. So, you have this kind of cohort of very aggressive investors that got the growth story or the growth potential of Afterpay and did very well out of it. So I guess all of that compelled us to write a book. Me and James, as I said earlier, decided we would write a book. It was very difficult and very enjoyable, and it pieced together these are some of the kind of elements that we. There was Nick's dad, Ron Molnar, who drove an Uber, and in the early days he was a bit of a salesman. He'd pick up somebody. He'd take someone to the airport. If they were a retailer, he'd tell them that they need to put Afterpay on their platform. If they were a fund manager, he would tell them they need to buy it, or a stockbroker. Nick's grandparents, Nick's grandmother wrote a book, so we got the whole family history going back to pre-war Hungary and the rag trade that runs deep. There's Q Group. There's a fascinating side story about Touch Corp. The founder passed away and bequeathed a $1 billion fortune to his family, which became quite an aggressive fight. And then there's the lobbying, which is like, that's a picture of Parliament House, but Afterpay, the story of Afterpay's lobbying is also a story within a story. So, yeah, and that's the Afterpay story in charts and little things. Kim Kardashian was a big moment. She's a US influencer that told her customers to use Afterpay one day, and that really, as you can see from that chart, was beginning of the beginning of the boom times. And yeah, and this kind of chart shows that this is actually a report from a very bearish analyst on Afterpay who still thinks that they're going to grow their revenues by 10 times, but their view is that the buy now, pay later space has become so popular and competitive that over time Afterpay will struggle to make their 4%. So even if they grow by 10%, if their margins halve, their valuations should halve. And yeah, this is just some of these screenshots I got off TikTok, which shows what a cultural phenomenon it is, and how there's definitely still a debate about whether it's promoting responsible spending or responsible lending. Like, if you watch these videos, you don't exactly get the impression that Afterpay is a budgeting tool. That's for sure. Yeah, and another kind of very fascinating side story is like a lot of these big tech companies like Canva and Uber, their growth had all took place in the private markets, but Afterpay, by accident or circumstance, was a great tech/growth company that the whole almost entire journey, pretty much the entire journey took place on the ASX.
Yeah.
So you have like a hairdresser and a tradie up in North Queensland that got the returns that a Sequoia or a venture capital fund would have got by kind of, a lot of them got the their wives or their girlfriends or they were retailers themselves, just got the idea, got the power of the concept and realised it was listed and piled in and made a lot of money. So yeah, it was really kind of a early sign of this retail revolution, and now as to today, they got taken over by Square, so the whole valuation debate has died down because Square has slapped a price on them. So, that kind of happened the day before our book launched, amazingly. And there's plenty of comedians on the internet that have got their view on Afterpay and Square before and after. Now it's become ubiquitous. It's not going anywhere, that's for sure. It's a $40 billion company. It's growing its customers. It's embarking on controversial campaigns. It's now, one of Afterpay's early benefits was that it didn't have to acquire its customers. Most tech companies, growth companies, their biggest cost is they have to pay to acquire a customer. They've got to market and, Google ads But Afterpay was just marketing to the merchants, and once the merchants took them on board, the merchant would market Afterpay to all their customers. Yeah. But now, I think as a sign of maturity, they're marketing. They're sponsoring Fashion Week, and they're putting their logos on buses, and they're hiring Rebel Wilson. So I don't know if that's top of the market, but there you go.
Yeah. Well, I think I know that we're leaving a little bit of time for questions, which Mike, if anyone wants to ask questions at the bottom.
Yeah,
of the
please
screen.
just put it at the bottom of the screen, Q&A thing.
Yeah. So I mean, I think that the comment that you made there about not having to buy your customers is really interesting. Basically they got a distribution network for free.
Yes.
And that's sort of, something that I've learnt in this area is that, with the exponential growth of some of the technology companies, if you haven't got that huge spend and have got a natural distribution network, once you've got the distribution network, in a sense, you can work out what your product is.
Yeah, exactly.
Rather than the other way around.
Yes.
And I think the other thing, for Australia and Australian investors, it's a great success story, Australian success story.
It is, yeah.
In a sector that's actually quite small on the ASX. I mean, the technology sector in the ASX is still only about 5%, whereas in the US it's about 25%. But the technology sector in Australia is growing quite quickly. There's now about 580,000 people employed in that sector. It's about 6% of GDP. So, for mine, in keeping an open mind, and after seeing Afterpay, it's been, I think, focused people's mind on that. And we've got one of the questions here that from someone who's asking that with looking at the with looking at the Afterpay story,
Yeah.
what in your mind differentiated them to other companies that haven't made it?
I think an important part was the founders. You know, you had a good mix of a young, hungry, entrepreneurial guy who was a bit kind of naive, but that was almost a strength and a weakness. And then you had a 20-year-old banker, you know, banker type who lived and breathed capital markets for 20 years and knew how to navigate it. So you had this very good mix of youth and experience, but not too much experience. That was a big part. They also prepared to hire well. You know, they knew what they could do and what they couldn't do. You know, they recruited very well. They got good people both here and in the US to help grow. They were happy to delegate. They knew their weaknesses. They pivot. I hate using this word, it's such a techie word.
Yep.
Pivoted, but they did pivot a few times. They had their backs against the wall, and they knew that they had to change things and respond. You know, especially on the regulatory front. But I think that what they unleashed was powerful. But they kind of controlled that. You know, that bucking bronco. They did you've really got to be impressed with how they managed that. They great product, but well executed.
Quality of people.
Yeah, I think there's a quality, and I wouldn't limit it to the founders. You know, they were obviously a massive part, but their strength was that they knew who to bring in and when. So
The network.
Yeah.
Jonathan, just another question. What are the possible or likely regulatory responses for these credit vehicles in the light of consumer protection?
Well, look, the consumer protection debate is an interesting one, and I've got a lot of sympathy for it. You know, the consumer groups have often been the nemesis of Afterpay from the very beginning, and these consumer groups are out on the front line. You know, they're getting the phone calls from people in financial hardship. So you can't be dismissive of, you know, the people that are kind of fans of Afterpay or observers can't be dismissive of those arguments. They are talking to people in distress, and the banks often say that, you know, they want to stay on the Afterpay platform, so they'll service their Afterpay, but they will fall behind on their utility bills and other things. So there is an issue. I think they will be regulated in time. I mean, they're moving into money products now, and the sense is that in time, the Afterpay will have to come under some kind of regulation. I guess the beauty of them is they've managed to avoid it through their growth path, and now they're big enough where they can afford to deal with it. But if the kind of regulation that may ultimately had come earlier, they would have had a very, very, very different trajectory. But look, I mean, I personally think, given how large it is, it's kind of crazy that it should stay unregulated. They did manage to negotiate their own code of conduct, which people are very cynical about. You know, like this, don't worry, guys, we'll write the rules, but we'll see. They need to be tested, and it's too big now to kind of totally ignore and leave to their own devices. Yeah.
Another question coming through, and this could be for Grant as well, actually.
Okay.
What's your view on Zip? Do you think they'll be taken out as the bubbles burst, or with so much competition, including the banks and what the banks that have moved into the buy now, pay later sector?
Oh, look, Zip is a difficult one for me to comment on. I know the founder, Larry, was one of the first guys I met when I came to Australia. He was a friend of my cousin, and he's just a lovely guy, a really funny guy, a good guy, smart, you know, great mix of intelligence and, and social skills. Just a very nice guy to be around. So I'm not surprised he's been so successful. What I kind of would say, like objectively standing back without comparing them to Afterpay, I think Zip and Afterpay were good for each other. They're very fierce rivals, but I think Zip allowed Afterpay, when they were hauled in front of Senate committees, to say, well, it's not us, we're an industry, you know, it's not just us, it's us and Zip.
Yep.
I think that helped. I think Afterpay elevated Zip too. You know, the huge success of Afterpay brought capital and attention to the sector and helped Zip. I think Zip's model is slightly different. You know, they buy now, pay later seems, Zip people might correct me if I'm wrong, but paying for that Afterpay introduced seems like a loss leader to try and bring more people into the Zip system, so they, you know, you can do more, you have more types of products. Their QuadPay product in America is like a competitor to Zip, and that's gone very well. I think they have a slightly different model, but it's equally viral. Look, I think Afterpay and Zip, they've all now they're all established, so they've all got to deal with their next level of those serious financial players.
And have they built a moat around them that means they're, you know?
I mean, you'd think not, but they've built brand moats. You know, they're very strong, powerful brands. Like Larry's built Larry's built a very powerful brand. You know, as is Afterpay. So look, I wouldn't write them off. I think they know what the next generation wants and needs from banking and finance. So I wouldn't dismiss them. I wouldn't bet my house on them, but I wouldn't dismiss them.
Jonathan, I think given the time, I've got one more question. It's a behavioural finance question, which Grant, I know you'd like as well. In your discovery of this book, could you comment on your observations on the changing dynamic of some investors to take on an increased level of risk more broadly?
That's a difficult one. I think there's definitely... The one thing I'd say about Afterpay is like a lot of people don't want to hear the story. It's very... They either thought about buying or sold too early or, you know, or... were dismissive of it. So I think either I'm trying to answer the question in the context of the book, but Afterpay definitely generated this sense of FOMO, and I think that sense of FOMO absolutely has encouraged more investors to take more risk. You know, like they read about some guy in Queensland that's made $10 million from Afterpay or from some stock, and absolutely, I think it drives a lot of people, not crazy, but it compels them to take more risk, you know, and they look at themselves and go, well, if I deployed that, you know, the exponentiality of what Afterpay did certainly awoke and stirred some animal spirits. So, yeah, that's what I say. Whether institutions have or haven't, potentially, I think there was, like as that slide showed, there was a risk of not owning Afterpay that they suffered for. So, yeah, I guess risk is a multifaceted kind of concept, but that would be my observation, is that it stirred the FOMO juices.
Yeah, I think there's certainly a lot of, you know, this market, there's a lot of momentum, obviously, but there's also some great success stories. But then there's also a lot that haven't made it that you don't read about. So
and there's also a lot of stocks that have done exceptionally well that aren't in the paper. So there's 10 and 20 and 30 baggers that just... The thing about Afterpay is such a retail stock. You know, people used it and debated it and talked about it. So it was so front and centre. You know, such a touch consumers and politicians, and so maybe that's why like the Afterpay's got more attention than others.
Okay,
there you go.
Well, Jonathan, thank you very much.
My pleasure.
Really enjoyed that. Really enjoyed your insights and what have you. So appreciate you coming in for a chat.
Absolutely.
Grant, thank you as well. Thank you for being inquisitor and asking all the questions. If anybody would like to have a book of Afterpay, any of our clients that is, please let us know and we'll send you a copy of the book. It is a very good read, as I've said. I hope you enjoyed the webinar. If you do have any questions or if you do have anything you'd like to discuss with Grant, myself, or the rest of the Providence team, please give us a call. Thank you very much. Stay safe and goodbye. Thank you.
for a full report of our outlook, please see our website.